welcome to Breaking News to Trading Moves.
Glad to be here.
I'm eager to get into this one because we're looking at a situation that, on the surface, just looks completely backwards.
It does look contradictory at first glance.
Absolutely.
Yeah.
I mean, we usually assume that when a company beats its earnings estimates, everyone cheers, the stock goes up. That's kind of the rule.
That is the standard playbook.
But we just saw the exact opposite happen with a major tech player. They posted numbers that were, technically better than expected, and the market immediately punished them for it.
And that is why we have to look past the headline numbers.
Yeah.
Because the devil is always in the details.
Or in this case, the margins.
Exactly.
And the margins.
Right. So the specific culprit we're looking at today is a global memory shortage. It's starting to really bite. And it's not just a supply chain headache. It's actually changing who makes money and who loses money in the hardware sector.
It's a classic case of what we call margin compression. So our mission for this discussion is pretty straightforward. We are analyzing the silicon squeeze. We're going to look at the headline event that kicked this all off.
Right.
And then identify the specific market winners and losers from these rising component costs.
And we should keep this practical. We aren't here to make, wild predictions about the future. We want to understand the mechanics of what's happening right now.
Exactly. No hyperbole today, just the math. So let's start with the event that put this whole thing on the radar. We're talking about Cisco Systems.
Right. So Cisco reported their fiscal Q2 results.
And if you just looked at the top and bottom lines, you'd think...
everything was fine.
Exactly. You'd think everything was fine.
Correct. They reported revenue that came in above expectations. They reported EPS, earnings per share, that was also above expectations.
So in a normal world, you'd expect a polite round of applause.
At least. But instead, the stock sold off hard.
Because of the gross margin.
Because of the gross margin. It was a disappointment. And when you're a hardware giant like Cisco, that gross margin is the health metric everyone watches.
If that number slips, it doesn't matter how much revenue you brought in.
It means you're keeping less of every dollar.
Okay, hang on a second. For everyone listening who isn't a CPA, let's define that clearly. When we talk about gross margin compression for a company like Cisco, what does that actually look like?
Okay, think of it this way. Gross margin is just how much money you keep from every dollar of sales after you pay for the cost of making the product.
The cost of the ports.
Exactly. So if Cisco sells a switch for, say, $1,000 and it costs them $350 to build it, their margin is healthy. But if the cost to build that switch suddenly jumps to $400 because parts got expensive and they can't raise the price, well, they keep less profit. That's margin compression.
And they were pretty explicit about why this happened, right? It wasn't some mystery.
No, not at all. They were very clear. They cited a jump in memory costs, unexpected and sharp.
So the parts they need to build their networking gear just got way more expensive to buy.
Precisely. And the real problem is the timing. When the cost of ingredients, in this case memory chips, goes up suddenly, you can't always pass that cost on to your customer immediately.
You got contracts in place.
You might have contracts in place that set the price for 6 months, maybe a year.
That puts them in a really tough spot. I saw they said they're trying to fix this by increasing prices and renegotiating.
Which is never a quick process. You can't just call up a massive enterprise client and say, hey, the price went up yesterday, so pay us more today.
It takes time.
A lot of time. And because those fixes take time, Cisco had to guide to a lower gross margin for the current quarter as well.
And that is what spooked the market.
It is. It's the realization that this isn't a one-off blip. It's a pressure that's going to stick around for a bit.
I think there's a broader lesson here too, isn't there? We hear so much about AI demand driving everything in tech right now.
We do. And the assumption is often that if AI is booming, every single tech stock should go up. But this proves that just isn't the case.
AI demand doesn't lift every stock equally.
Not at all. In fact, it can hurt some of them.
How so?
Well, just think about where the demand is. The demand is for high-performance computing, which needs a ton of advanced memory. That demand creates a shortage.
Oh, yeah.
When you have a shortage, the price of memory rises. So the value, the profit, it moves up the supply chain.
To the people making the
To
components.
the component makers, and the people buying the components, the hardware vendors or OEMs, they get left holding the bill.
They get squeezed.
Exactly. Unless they can pass those costs on immediately, they're the ones absorbing the inflation. So you see this divergence. The component makers win, and the box movers lose.
Okay, so that actually leads right into the next point, doesn't it? Let's break this down into the specific winners and losers here.
Yeah.
Let's start with the supply side. The companies that are benefiting from the exact same problem that's hurting Cisco.
The winners here are the ones with pricing power. It's that simple.
And category 1 has to be the memory manufacturers themselves.
It has to be. I mean, this is just simple supply and demand. When supply is tight and demand is incredibly strong, especially for that AI hardware we mentioned, the pricing power belongs to the chip sellers.
So they could just charge more. Better revenue, better margins for them.
Correct. While Cisco is complaining about high costs, these companies are celebrating higher selling prices. And it's not just about revenue, it's about operating leverage.
What do you mean by that?
Well, these companies have huge fixed costs. It costs billions to build a factory. So once you cover those costs, every extra dollar of a price increase flows almost purely to the bottom line.
Got it. So who are the main names here to watch?
The big players you want to look at are Micron Technology and Western Digital.
Okay, let's get the tickers for those. That's Micron Technology, ticker MU.
MU.
And Western Digital, ticker WDC.
WDC. These are the direct beneficiaries. If the price of memory goes up, their earnings reports should reflect that directly.
Makes sense. Okay, so moving to the second category of winners. This one is a step further back in the chain. Semiconductor equipment.
This follows the logic of how do you solve a shortage?
You build more stuff.
Right. You build more supply.
Yeah.
To do that, the industry has to increase its capital expenditure, or CapEx. They need to build new factories or fabs.
And fill those factories with the machines that make the chips.
So the shortage triggers a flood of orders for the equipment makers. When memory is scarce, manufacturers rush to expand capacity.
But isn't there a lag there? I mean, if I order a machine today, it doesn't show up tomorrow.
Oh, there's a huge delivery lag, sometimes 12 to 18 months. But the stock market reacts to the order book, not the delivery date.
Oh, okay.
When companies announce they're spending more on CapEx, the equipment makers book that revenue in the eyes of investors.
So who are we looking at in this space?
The heavy hitters here are Applied Materials and Lam Research.
That's Applied Materials, ticker AMAT.
AMAT.
And Lam Research, ticker LRCX.
LRCX. And it's worth noting that Lam Research is particularly relevant here because they have very high exposure to memory specifically.
Oh, really?
Yeah, they make machines essential for stacking memory cells vertically, which is how you make these new high-capacity chips. So if memory is the story, Lam is often the main character in the equipment space.
That makes sense. Now, category 3 for the winners. This one feels a bit more nuanced. We talked about how hardware vendors get squeezed, but you have a group here called infrastructure with pricing power. So not all hardware vendors are stuck.
Not all of them, no. It really comes down to leverage. If you have extremely strong demand, meaning customers desperately need your product right now, and you have a unique position, you can pass those costs through much faster.
So they don't have to eat the cost. They just update the price tag and the customer pays it because they really have no choice.
Essentially, yes. They can protect their margins much better than their peers.
Who fits that description?
We're looking at companies like Arista Networks and Vertiv.
That's Arista Networks, ticker ANET.
ANET.
And Vertiv, ticker VRT.
VRT Arista, for example, is deep in high-speed data center networking, which is critical for AI clusters. That demand gives them the leverage to say, hey, memory costs are up, so our switch costs are up.
And the big cloud providers will just pay it.
They'll likely pay it to keep their build-outs on schedule, because a 5% cost hike is a rounding error compared to the cost of delaying a billion-dollar AI data center.
And Vertiv, what's their angle?
Vertiv does power and cooling. You literally cannot run these new hot chips without liquid cooling and massive power management. It's non-negotiable.
So they have leverage.
They can dictate terms much better than, say, a standard server maker.
So in the winners column,
yeah,
the people making the chips, the people making the machines to make the chips, and the hardware makers who are vital enough to just pass the bill along.
That's the winning team in this specific silicon squeeze scenario.
All right, let's flip the coin. We need to talk about the losers. The companies facing the same bill of materials inflation that hit Cisco.
We can group these into a few buckets as well. The first one is, well, it's pretty obvious, networking hardware OEMs.
The peers to Cisco.
Right. If Cisco is seeing memory costs spike, it's highly probable their competitors are seeing the exact same thing.
They're all buying from the same global supply pool.
They are. And if Cisco, who has arguably the best supply chain team in the world, is seeing costs spike, you can bet their competitors are feeling it too.
And if component costs go up faster, then they can raise prices.
Margins compress. It's the same math.
So besides Cisco, who else is in this bucket?
Hewlett-Packard Enterprise is a key one to watch here.
Okay, so we have Cisco Systems, ticker CSCO,
CSCO.
and Hewlett-Packard Enterprise, ticker HPE.
HPE. With them, you'd be looking for commentary in their earnings that mirrors what Cisco said. Are they seeing that input cost pressure?
Moving to the second category of losers, server and enterprise hardware. Now, servers use a ton of memory.
They do. Memory is a massive line item in the cost of a server. If you look at the bill of materials for a high-end server, the memory modules, DRAM, flash storage, they make up a huge percentage of the total cost.
How much are we talking?
It could be 30, 40, sometimes even 50% of the cost of the box, depending on the configuration.
Wow. So a shortage here hits them right in the wallet.
It does. It raises costs, obviously. But it also creates delivery risk. If you can't get the memory you need, you can't ship the server.
And if you can't ship the server, you can't book the revenue.
It's a double whammy, higher costs and potential delays. And the server market can be very competitive, so raising prices is hard.
Who are the names here?
Dell Technologies and Supermicro Computer.
That's Dell Technologies, ticker DELL.
CEO.
And Supermicro Computer, ticker SMCI.
SMCI. Supermicro has been a real darling because of AI, but they are not immune to component shortages. If they can't get the parts, it impacts their bottom line just like anyone else.
It's a good reminder that even the hottest sectors have physical constraints.
Absolutely. You can't download RAM. You have to buy it and plug it in.
All right, the third category of losers. This one might fly under the radar for some people. IT resellers and distributors.
The middlemen.
Why do they get hit? I would assume if prices go up, they just take their percentage cut on a bigger number, right?
In a perfect world, yes. But in reality, they often get squeezed the hardest in the short term. Their business model relies on moving huge volumes on razor-thin margins.
Okay.
So when vendor costs go up, when Cisco or Dell raises their prices, the distributor has to pay more immediately.
But can't they just charge their customers more?
They can, but there's often a lag. Pricing resets take time to filter down. In that gap, the distributor's margin gets crushed.
Plus, I imagine if the price tag jumps, customers might hesitate.
Exactly. If you're an IT manager and the server rack you wanted to buy is suddenly 15% more expensive, you might pause that order. You wait for approval.
And that leads to choppier demand.
Right. The distributor is sitting on inventory that isn't moving as fast. That's a killer for their cash flow.
Who are the main tickers here?
We're looking at Avnet and Arrow Electronics.
That is Avnet, ticker AVT.
AVT.
And Arrow Electronics, ticker ARW.
ARW. These companies are the plumbing of the electronics world. If the pressure changes in the pipes, they feel it first.
So we have the landscape. Winners are the component makers and those with leverage. Losers are the hardware OEMs and the distributors who get stuck with the bill.
That's the layout. It's a transfer of wealth from the system integrators to the component creators.
Now, for someone listening who wants to track this, what should they be watching for next? We can't just wait for the next Cisco earnings report in 3 months.
No, you want to be proactive. I would advise looking for specific indicators in upcoming earnings calls across the whole tech sector.
What specifically?
First, just watch memory pricing commentary. If you hear memory companies saying prices are firming up, or if you hear more hardware companies complaining about component inflation, that confirms the trend is persisting.
It confirms that components up, OEMs down, dynamic.
Right, and there are specific buzzwords you should listen for. If you hear these, pay close attention.
Okay, hit me with them.
Pass-through timing.
Pass-through timing, got it.
Contract repricing.
Contract repricing, okay.
And lead times.
Lead times. Why do these three matter so much?
These phrases tell you who is eating the inflation. If a CEO says pass-through timing is lagging, that's corporate speak for our margins are going to be bad because we can't raise prices fast enough.
Okay.
If they talk about extending lead times, it means they can't get the parts.
It's like a decoder ring for these earnings calls.
It really is. You have to listen to how they describe the pain. Lead times extending, for a hardware maker, means they can't build the box. But if a memory company says lead times extending, that's bullish. It means demand is outstripping supply.
And we see more hardware names citing this same issue.
Then the market may solidify this into a broader theme trade. You might see a rotation where investors go long on memory buying the chip makers and short on hardware OEMs selling the box movers.
Because the money's just flowing from one pocket to the other.
Exactly. It's a transfer of value within the supply chain.
This has been a really clear look at how a single-factor memory costs can completely change the narrative for these massive companies.
It shows you can't just buy tech or buy AI blindly. You have to look at the mechanics of the business. Are they a price taker or a price maker?
So to recap quickly before we wrap,
Sure.
Cisco beat on revenue but fell on margins. The reason? A memory shortage.
Correct.
The winners are the folks selling the memory Micron, Western Digital, and the folks making the equipment Applied Materials, Lam Research. Plus, infrastructure players like Arista who can push price increases through.
Yes.
And the losers are the folks buying the memory who can't raise their prices fast enough. Cisco, HPE, Dell, Supermicro, and the distributors like Avnet.
That is the summary. Good earnings can be overshadowed by bad margins when component costs rise.
It really makes you think about the durability of this AI boom from a different angle.
It does.
And here's a final thought for you to mull over. We keep hearing about the insatiable demand for AI hardware. Infinite demand, right?
That's the narrative, yes.
But we know that economics always wins in the end. Prices can't just go up forever.
They usually can't, no.
So if the cost of memory continues to climb, and those costs eventually have to get passed on to the buyers, at what point does the price of hardware become high enough to actually dampen the very AI demand everyone is counting on?
That is the multi-billion-dollar question. Is demand truly inelastic, or will sticker shock eventually slow down the build-out? If the cost of an AI server rack goes up 30%, do companies just buy fewer racks?
Something to keep in mind as you watch those tickers. Before we go, a quick reminder. This is not financial advice or buy or sell recommendations. This is purely the opinion of the author.
Always do your own research.
Thanks for joining us on Breaking News to Trading Moves. We'll see you next time.